Welcome to this episode of Let's Make Millions. I'm Rob Medved, CEO of Canal Media. We're here in Canal Media Studios. Managing partner Bill Raymond. How you doing, Billy?
I'm good.
And Jason Mandel is our guest. Jason Mandel is Mandel Family Offices. He's got some other structures. We're going to do a deal with him, direct to consumer. To bring a vehicle to life through television and social media. I kind of thought about this coming into today. We talked about this a little bit. Let's make millions, but let's keep millions. Let's grow millions. And that's really what Jason is here to talk about.
Oh, yeah. I mean, he really, breaks it down for you very simply where, you don't have to give so much away in taxes and it's not that difficult, but you need to learn. And you don't even have to learn it. You have to go to someone like Jason.
Yeah, 100%. Brilliant guy. We could talk to him for hours. We talk about how the billionaires use these vehicles to shelter their money. It's quite interesting.
Very interesting.
We talk about 401ks and how they're not really that great of a vehicle. Wall Street kind of screwed up, not really giving us everything that we want. And, the banking industry, as we've seen it unsettle here, there's a lot of uncertainty in the economy, and there's a lot of confusion on how to create wealth for yourself, protect wealth. We talk about avoiding taxes, but not really avoiding taxes, like pay taxes, but do it in a very, very smart, structured
way. And we speak to, you don't have to move out of the country. You can stay here and do it while, you could move to somewhere like Puerto Rico, but if your wife won't allow you to move there, you can stay here and you can still.
Yeah. And you don't need to be a billionaire. You just have to have some assets. And oftentimes he talks about people don't actually know what their net worth is. They may have more asset value than they actually know.
Correct.
And so this is good for somebody young, somebody old, alike. A lot of interesting stuff. Dry topic normally, not today. As part of Let's Make Millions, we also have a facet called Let's Give Millions.
Yep.
And Jason Mandel's charity of choice, which we're going to donate to on his behalf, is Gift of Life, giftoflife.org. They're looking to cure blood cancers through cellular research. You go on the website, you get a swab.
Yep.
You send that in. They're looking for donor matches because they're trying to help people match the blood. Blood cancers rampant throughout the country, and it's a killer. We want to help them, help those people cure blood cancer.
Great
Jason
cause.
Mandel, great cause. Donate. Stay tuned. This episode of Let's Make Millions with Jason Mandel.
Feet, this is a shakedown, and you can rock and roll with an attitude. So good, so fresh, just the way you like it. So good, so fresh.
Welcome to this episode of Let's Make Millions. I'm Rob Medved, CEO of Canal Media. We're at the Canal Media Studios with Bill Raymond, my partner here, and our special guest, Jason Mandel, Mandel Family Office. You have been in the investment world for 25 years now.
Almost
plus,
30, yeah.
Almost 30 years. And, we're here to talk a little bit about marketing. We're going to talk about what we're doing with Jason here from a direct-to-consumer standpoint, how we can get what we're talking about here out to the masses. But at the core of being an entrepreneur is making money. That's the benchmark. And when you do go on to make millions or hundreds of thousands or whatever your net worth may be, you have a responsibility to it. And part of that responsibility has to do with investing and taxation, right? And it's often confusing to an entrepreneur. We're really, like we've talked about this, we're really good at what we
need
do.
help.
We're not good investors. I have not been a good investor, in finances and stocks over the years, even though I have a background in it.
It's not your fault, though.
I am awful. Like we are good at making money, but at least me. I'm not good at making money on my money or saving my money.
Yeah.
Full disclosure.
Yeah. Wall Street's kind of fucked, huh?
Yeah.
Okay.
Yeah.
Let's talk about that.
The model is completely broken.
All right.
You have every advisor that you'd like to think you could trust. Their own incentives are in effect against you.
Mm-hmm.
Their goal is to keep you just happy enough that you'll never leave, and they could continuously charge you 1% or 2% or whatever they charge you every year. So they don't want to take anything outside of what they're being told to do by their big company.
Mm-hmm.
And unfortunately, it's not in the interests of the consumer, in my view.
Yeah.
You have people that are charging this fee, and they're not performing. They're underperforming an index. They're going out there and they're saying, okay, let's benchmark ourselves to the S&P 500. Market last year was down 23%.
Yeah.
We were down 22%. Aren't we great?
Yeah.
Aren't we heroes? We saved you.
Right. Market's down
nonsense.
23. We were only down 22. You lost 22% of your net asset value.
It's complete nonsense.
Your 65-year-old, what does he do? What does she do?
And he's looking to pull out for 4% or whatever the number is to retire. Now they can't retire for another, what could be 10 more years.
Yeah.
It's such a flawed model. The answer is you can't be allocated to equities and fixed income alone. Those are two asset classes that may not perform, and last year's your best evidence of it.
Yeah. And equities, we're talking stocks, stock market.
Exactly.
Fixed income,
They're
bonds.
great. They're great for
yeah.
a 20-year-old that has 40, 50 years to work.
Yeah.
But if you have a drawdown, how are you expected to live in your retirement when you've lost 23%?
Yeah. What about the headlines of the guy, the decamillionaire, the billionaire, not paying taxes, using all of these strategies to kind of shelter income or avoid taxes or defer taxes forever?
It's unfair that the average person doesn't have access to the same insights. And in a way, I'm kind of guilty of this. I mean, I'll be straightforward with you guys. I've worked for billionaires most of my career. I've helped them minimize taxes in a legal, compliant way. We're not talking about interpretations of tax law. We're not talking about tax shelters. That stuff's nonsense.
Yeah.
Because eventually someone disagrees with someone else's interpretation.
Yeah.
And they challenge you on it. And then you give back all the money.
Yeah.
It happened, I remember as a kid in the 1980s. I remember a lot of people were losing all their money. There were Prudential, these tax shelters that went bad. I don't believe in tax shelters. And I think the wealthy, the very smart, they also don't really believe in tax shelters. They want something that is crystal clear in the tax code.
Yeah.
Because that can't be challenged, right?
So you told a great story to us months ago about you had structured a product when you were young. How old were you when you did this? Was it with a billionaire family? You know what I'm talking about?
Yeah. I worked for them in my 20s. I built my own structure, which was completely compliant. This was, again, nothing aggressive. This was the idea that this structure was a non-tax structure. The best way I explain it is I think about a Roth IRA. Everybody understand, or a lot of people understand what they are. You're taking after-tax money. You're putting that money inside of a structure, and whatever future taxation that's due on the gains from that pool of money, there's no taxes due. You've paid your taxes. When you pull that money out, there's no taxes due. It is an incredibly powerful tool. Now, the government limits how much money you could put into that. It's not a very significant amount of money. So I even have ultra-wealthy clients that I don't want to bother with that.
Because it's like $5,000 a year, something like that.
It's not worth it. What I've developed is a structure that is what I call a supercharged Roth IRA, that you could put virtually an unlimited amount of money into this structure and completely eliminate all future taxation. Yeah. And no one knows this. Very few people know this stuff
exists. Is this the structure that essentially you created when you were 25 years old? And you went to this billionaire family office, and we now know the investment advisors that they trusted that were probably in their 40s, and they were with a big investment bank.
The biggest.
Name in gold or black letters, whatever it may be.
Everybody loves them.
Everybody thinks they're it's
the
interesting.
Smartest guys in the room.
They're everywhere.
Yeah.
They are.
And a couple months ago, when we were talking about this, he said, the funny thing is, they just came out endorsing and promoting my strategy.
They just came out with their own product that they developed, and now they are showing everybody who's a client of the firm, this is the greatest way of eliminating, not just reducing or deferring, but eliminating taxation on your entire portfolio.
Okay.
And passing, by the way, that portfolio on to the next generation completely tax-free.
And so a little more detail on that. How do we do this? So give me a practical example.
Okay, so let's just say someone's got $1 million.
Yep.
That $1 million is in the form of maybe a brokerage account in their own name individually. The Jason Mandel brokerage account at any investment bank you could think of, or any investment advisor.
Yep.
Some people are a little more sophisticated. They set up an LLC, limited liability corporation. Why do they do that? Because maybe they want to take some deductions. Oh, I've got this expense. I'm going on a trip because I need to research a company. I want to deduct that trip. So some people set up
research a trip in like Hawaii. Maybe.
That would be you want to exactly.
And the LLC acts as a living entity, and you have to pay taxes on it.
Absolutely, whatever gains.
And so
you make.
whatever income you can essentially try and write things off against it.
That's right.
Yeah.
That's right. And it's a very common way for people to feel like they're shielding themselves even from, God forbid, litigation.
Yep.
Because you have this LLC protections. You say, okay, if I get sued, now they can't sue me personally. They're suing this company. That's fine. Again, fully taxable entity. Certain corporations, you're taxed, and then you're taxed when you take a distribution out.
Yep.
And then there's corporations that your taxes flows right through. So it's one taxation.
Okay.
Now, when you have that, that's great. Now, the next step of sophistication is to create a trust. A trust, you're basically giving that money to the next generation already. So you're managing, you're maintaining a level of control on it. But when you pass away, that money does not go into probate. That money is directly handed to the next generation. In effect, you've done it while you're alive.
Yep.
It's really a great structure. It does protect people. It allows you to control a little bit about, instead of just handing the money to your kids right away when they may not be able to handle it, you could still have some level of control.
Yep.
Problem with the trust is it's a taxable entity
Yep.
every year. So if you made $1, you're giving half of that away if you live in California.
Yeah.
It's gone. So when you're looking to compound your wealth, you're really hindered by that taxation.
Yeah.
That's why people love these tax-deferred structures, because eventually, like a normal IRA or a 401k, they say, this is great, I'm building all this wealth. But the minute you take it out, it's taxed.
Yep.
And
Heavily.
Heavily. And we don't know what the tax rate will be when you take it out.
Yeah.
People complain about taxes today. I think people forget about the late 1970s when on the highest end, the taxation was up to 90%. People don't even understand how counterintuitive that is.
Oh, that's insane. Say
It's
that
insane.
again.
Nobody thinks about that.
You're
So we're
s-
not in the worst
So
tax environment
we're
ever.
not. Right
No.
now, we're in a better tax environment than the 70s.
I have
That's
clients that I advise them to actually take their money out of their 401k, pay the taxes now, and enter into one of these non-tax structures that I focus on.
Yep.
Because they're better off, because we know what taxes are today.
Yep.
We don't know what they're going to be in the
And,
future.
and for these non-tax vehicles, you can invest as little as $2,000 a month, or
There's different structures. So there
Yeah.
are some requirements. Certain of these big corporations that offer, big asset management firms or big financial institutions, they limit the amount. So there are products that you're absolutely right. You could put very little, a small amount of money. It could be $2,000 a month. It could be even less. There are other companies that might have a minimum where it might be $250,000.
Yeah.
So really, you have to sit and that's what I focus on, right? You sit there, you try to understand someone's issue, and you try to figure out what's a good solution for them.
Yeah.
But going back to your question, is these structures are so flexible in that right now, if we bring it back a little bit, and let's talk for a little bit about some of these structures which people are familiar with, because I think that's a good way, instead of getting super exotic to this to something that people have never
Yeah.
heard about. When you look at something like, let's talk about insurance for a second. You have term insurance. A lot of people believe, I've got to protect my family. If I get hit by a bus, I want them not to be homeless. So here's insurance, super cheap, and almost no one ever accesses a term policy.
And a term policy is a policy that you're just paying. It lasts a certain number of years.
That's right.
And you're paying per year, and then the death benefit goes to whoever the beneficiary is. But when that time period's up, it's worthless.
That's right. And what's interesting, you look at all these big buildings that these insurance companies have, they make all their money on term insurance because
no one uses it.
No one uses it.
By the way, we weren't going to talk about insurance
No,
today,
we weren't gonna
but
talk-
we have to. We
That's
have
why-
to because it's element to the discussion. So you got
It is.
term insurance.
Yeah. Then you have something called whole life insurance.
Yep.
And you got a lot of people running around. I think there's 400,000 insurance brokers in this country. And they're running around trying to sell people and saying, look, instead of buying term insurance, buy a permanent form of insurance, which you'll be able to, you'll never outlive. You'll always have it, last till you die. And it's much more expensive. But the good news is you can get tax-free growth on that extra money that goes in every year. And most people, when they buy insurance in this country, they buy some term and they buy some whole life. And the idea here is that they're going to get a 5 or 6% dividend, but it's going to grow tax-free. It might be the best performing product that's out there because it's tax-free. And that's probably the main reason people buy insurance, is this tax-free growth of the cash inside of it. Now, Wall Street got a little more sophisticated and people were a little bored by that little dividend. So they said, well, what if we give you the upside of a stock market index like the S&P 500? But we're going to cap the upside. It's not going to be the full amount, but it's a lot of it. It's going to be 10 or 12%. But there's no downside. Now, most of America doesn't even know these products exist. They think they need to buy stocks. Now, stocks, if you're in a position where you're 40, 50, 60 and you're retiring, if you lose the money because of last year or other years, or there could be cataclysmic type, or even just think about a market like we saw in Japan over the past 30 years. Very
Stagnant, yeah.
Stagnant, but not really, because there was years up and years down. So what I love about some of these structures is that you capture every upside swing, none of the downside.
Incredible.
But people don't know about it. Because a lot of the people that sell these structures, they sell the traditional whole life, and this newer product called indexed universal life gives you the upside without the downside. Now, what I do is I kind of change it up, and I say, wait a second, I don't want to accept the products that you're offering me, Mr. Insurance Company. And it's fine. I come to them and I say, look, I want to be able to present the things that my clients are investing in. I have clients that invest in real estate. They invest in venture capital, private equity. I've got a client that invests in racehorses. I've got a client with automobiles that he renovates. You look at those assets, where do they fit into any of these structures? They don't. There's never been a solution for them. And that's what my firm is focused on since 2005, is allowing us to determine what is inside of one of these tax-efficient structures, so all that growth is tax-free.
So what are the billionaires doing?
That's what they do. They really take their assets, they wrap it in a tax-free structure, so they never pay taxes. And when they want to access that money, they do it through the form of a loan out of the structure. So if they want $50 million, they take it out of there, but there's no taxes due. Regular American.
It's a loan.
It's a loan. And that loan can get paid back if they want it to be, or they wait. And instead of paying it back, when they eventually, one day when they die, that money goes to their heirs, and it just gets reduced by the amount of loan. So imagine they're leaving their heirs $100 million, and they borrowed $30-40 million to live tax-free. The family still does very well. Yeah. But they don't. That loan gets reconciled at that point.
And you don't have to be a billionaire to utilize this structure.
I mean, I'm kind of tired of working for billionaires, frankly.
So what
it's
kind
not
of
that rewarding.
What kind of net worth?
It's financially rewarding. It's really emotionally. Yeah. It doesn't really make me feel good. What makes me feel good is to help somebody where it's a material difference to their lives. When you knock out all that taxation, that allows them to maybe work a little less. It allows them to have peace of mind. Allows them to do things that they otherwise wouldn't be able to do.
Yeah. So by the way, Jason, you have lost a ton of weight.
Thank you.
I mean, you look great. You. And I think, by what you continue to say here, as you get more confidence in how you invest, you feel better. You feel better by helping people, but plus by people you help. Rob and I struggle with this now. We work so hard in our business that we don't put enough time and effort into our own finances. So with someone like you, you can really help us.
I'm happy to. Yeah, it brings me a lot of pleasure. Really.
So what kind of net worth does somebody need to have in order to utilize the billionaire strategy?
I would say there's no number because people don't really understand their net worth. And what I mean by that is if you take an entrepreneur and let's say he's got a pizzeria he's running, right? It's a great business, provides enough money for him to live a nice life. That person in no way feels like a millionaire for the most part, right? He thinks himself a hardworking person. That's it. When you actually look at what that business is worth, it could be worth $1 million.
Right.
So that's an asset that's not liquid, right? They can't look at a bank account and see that if they want to sell it, maybe they'll get a price. And that's why I don't really put a number. When someone comes to me and they say, well, how much do I have to talk to you? I'll talk to anybody because I want to help people.
Right.
Even if I come back and say, look, you've got a great structure. Your current advisors are doing well. So my Mandel family office, the idea here is that it takes a holistic view on someone's wealth. So we help people do their taxes. The first thing we do is look at taxes because so few people understand it. They pay somebody who, in my opinion, for the most part, is a record keeper. Yeah. There's someone, you bring them your forms, you say,
and
this
just
is what
processing them.
It's a paper.
Filling in the blanks.
Put it into a program.
That's right. That's all they do.
It's a program.
And I actually think that the CPA industry is dead unless they innovate. I think they must change their view. I don't think they're just there to be record keepers. I think they're there to provide real valuable insight to help families understand what they need to do to prepare for retirement. I mean, I launched a new company called Care Trust. Care Trust, it's caretrust.life. All it does is it helps people fund long-term care. I'm so blessed. I have a 100-year-old grandfather.
That's amazing.
And he just went into assisted living.
Wow.
Just recently.
It's funny. This year I've heard more people tell me about their 100-year-old grandfather or parent or whatever. People are living a lot longer. So this has to come into the equation.
And they're outliving their savings.
Yeah.
That's what my grandfather.
And that's the big fear, right?
For
sure. You hit somebody in their 80s, 90s, and you can feel them just kind of, they get real scared. They tighten up because they know that's bleeding out.
And there's no reason to be afraid.
Yeah.
If you structure things properly. So what Care Trust does, it's the first company in the world to lend people money against their insurance policies. So historically, if you had a policy, you'd ask for what's the cash surrender value. You could borrow some of the money, if not all of it, out of the policy. But we're actually lending money against the benefit. And the idea here is that if the kids are being asked to help pay for mom and dad's long-term care, they'd rather it come out of a policy that they may or may not get in the future, because some people run out of money. They can't even keep the policies going.
Yeah.
So here we take over the premiums that might be due to pay the carrier, and we take money out every month to allow the person to live in dignity and live in a nice retirement home instead of a very poor quality one. So it's a lot of fun to do this, and families are they're feeling the benefit of this. And they're saying this is amazing. And by the way, the loans are not due back until the mortality.
Yeah.
So there's no pressure to pay it back. It's very compelling. Now, there's an alternative market that I was very involved in, and even the creation of it, called the life settlement market. And that's a market that Warren Buffett's been a big believer in.
Yeah.
And this is a market where someone no longer wants their insurance property. They could sell it. So you get a present value on the future cash flow. The problem is these Wall Street guys are sharks. So what do? The Wall Street guys say, look, I've got good news for you. You're so healthy. You're 80 years old, but you're going to reach 100. That means that I can't give you very much money for it.
They discount it a ton.
Now, the real numbers are kind of shocking. 1% of 80-year-olds reach 100.
Right. They know this.
Right. But Wall Street comes back and says, good news, you're that 1%. You're going to live. It's not always the case. Yeah. So if they buy cheaply, they'll obviously make more money. If the person dies a year later and they're paying them 10 cents on the dollar,
They kill it.
Literally. It's horrible. And they kill that person. That family is angry. That family is saying, what'd we do? We left all this money on the table. So Care Trust, we feel, is a really consumer-friendly product, which allows people just to borrow. So if, God forbid, the parent dies in a year or two, they just borrow a year or two of money to pay for long-term care. And the rest goes to the family.
Yeah.
So
That's fantastic.
It's a very different value proposition. No one's ever done this before. We're getting a lot of traction.
It's awesome.
So you used to live in New York. You're from New York originally?
Yeah. Born in New York. I lived there almost until 2008. I was born in 1974, almost 50 years old now.
And in 2008, you moved to?
I moved to Connecticut. So Connecticut was, and it was there you go, hedge fund
Move
central.
it up.
My clients demanded it. I was working for these big hedge fund guys. I was giving them, insight. So I had to move out there, and I was saving taxes because New York City has an extraordinary tax rate. You guys know, living in California, it's very comparable. And I said, look, if I just move, I'll save this money. And what's interesting is, as soon as I moved, I was a decent taxpayer, New York City went after me. They said, you didn't move. I said, what are you talking about? I didn't move. Here's my new house. Look at the records. I bought a house. They said, no. You must be living in New York City.
Yeah.
You've been here. I said, okay. Thank gosh, at the time I was drinking coffee. So I was going to Starbucks every day.
So you saw.
So you had a trail.
I had to show them I'm really in Connecticut.
Yeah.
And I had a
you
brother.
hear about this all the time.
It's crazy.
Oh, somebody's going to move to Nevada. Somebody's going to move to Florida. And it's this whole 50%. I got to live there 50.001% of the year or something like that, right?
Yeah.
So you have to truly establish residency. You have to really be, and the government is now really, really looking at that, especially with somebody that has a little bit higher net worth, right? They're going to, it's worth their while to go after that money to the point where guys were having cell phones and having somebody make calls from a cell phone in Nevada, even though they weren't there, to try and establish some kind of residential
There's always going to be tax
trail
fraud. It's always going to be there. Tax fraud is something you're never going to. People will commit tax fraud, and that's what I say to people: don't commit tax fraud. There are legitimate strategies. You don't have to be a criminal. You can live your life comfortably and do it right.
One of the legitimate strategies is then you just move to Florida.
Well, that was eventually what happened. So what eventually happened to me was I was tired. By 2019, I'd been giving this advice to all my clients. So many of them started to move. And finally, I spoke to my wife, and I said, look, let's move to Florida.
That's not actually what you said.
What did I say?
You had said you wanted to move to Puerto Rico.
That's right.
Okay. So what, and Puerto Rico is, this is my naivete, Puerto Rico is a U.S. territory. So are you a citizen of the United States if you live in Puerto Rico?
Absolutely.
But the taxation down there is different than if you live anywhere in the United States.
The tax authority, they have their own tax authority, and they are not subject to U.S. IRS taxation, no federal taxation.
No federal taxation. So what is their tax rate?
It's lower, but it's comparable.
It's single digit.
No. So there's a program for non-Puerto Ricans who want to move to Puerto Rico. There's been such devastation from the natural disasters, from the economic malaise. There's been a lot of criminality from the government there. There's been terrible things that have gone on into the Puerto Rico people. And the U.S. federal government recognized that there's been a push to make Puerto Rico a state. Before they do that, they're trying to figure out a way to maintain the situation and try to bring back
So they're
some
incenting,
business.
essentially, they're incenting people to. So we do have some clients that have moved there. They've moved their families there. You got to live there, just like with Florida or Texas or Nevada, you have to live there over 50% of the year.
That's right.
But once you establish residency over a period of time, it's recognized, and then you are subject to less tax.
If you get approved under this program, the program today is called Act 60. It was previously called Act 20. And these were economic development programs where you'd have to create jobs. You'd have to donate a certain amount of money to charity. You'd have to do a lot in order to qualify for the program. But the program is very compelling. It offered a 4% tax rate.
Yeah.
Jeez.
And this incented there was a lot of crypto guys, a lot of hedge fund guys, billionaires that would go down there, and they did. They put money into roads and schools and everything because they were going to move their families there, and they wanted it to be nicer than it was. So I guess it worked.
It did. It did work, actually.
But that's quite the plug to pull. Your wife wouldn't let you do that. I can't blame her.
She did not want to do that.
Yeah. So you ended up in Florida.
Yeah, that was a good compromise. I thought it worked out
Still
well.
a good tax haven, and
Well, at least on a state tax base. Zero state taxes. So you gave yourself an immediate bonus. Some people like the heat, some people don't. But for me, I love it. I've always kind of wanted to live in Florida, so for me, I was very, very happy. And a lot of my clients have since left places like New York.
we have some larger clients that have moved there.
Yeah.
Because you save so much money on the state tax.
not everybody can do that. But everybody has the ability to jump into all of these other vehicles we've talked about.
Absolutely.
What do you think about 401ks?
401ks are horrible. I mean, I don't know what to say. I hate them. I think people they've drunk the Kool-Aid where they believe that they should max out their 401k every year. They're putting money. Yes, they get the deduction. I think that's wonderful to get a deduction. But the problem is when you pull the money out later in life, it's taxable.
Yeah.
And we don't know what tax rates are going to be when someone retires.
Right.
So you have this horrible situation where the people that manage 401ks for the most part are managing them in traditional strategies like the stock market. And I don't believe retirement assets should be tied to the volatility of the stock market. None of my strategies, especially when I have clients that are looking to retire, have anything to do with stocks going up. I want to do things that are not correlated to the stock market, things like asset-backed lending. And if you look at a traditional asset management company, all the big brokerage firms, they don't even offer it. I think that's horrible.
Really? They don't even offer it
They really don't.
because they're such bad vehicles
Well, I think
For them to earn money, probably,
Correct.
right?
Yeah,
I mean, 'cause
they don't.
at the end of the day, if there's not a commission in the product, or if it's not something that benefits them, they're not going to push it as much, right?
Exactly. There's a big incentive just to do something simple and easy, buy stocks, buy different funds, and charge 1% or 2% or whatever they charge, and they keep the client. They think it's liquid. A lot of these structures that they theoretically, legally could offer them, they may even have it on their platform, but the compensation that they give to the financial advisors is so minuscule that they incentivize them not to present these ideas to their clients, even though they're lower risk.
Yeah.
Even though they could really help people. I feel horrible when I talk to people that were looking to retire, and even after last year, they're putting the retirement off 5 or 10 years. So those structures we were mentioning, which have the upside but no downside, imagine if you own those structures, and let's say you were a Japanese citizen for over 30 years, the indexes are basically flat, but there's been swings. So if you could capture every positive swing and have none of the down.
Yeah. And that's capturing some of the positive swing, not all of it, but limiting your risk on the downside.
That's right. And there are structures where you do capture all of it. So, for example, if you invest in the fund that's inside.
How is that? I don't even understand how that is possible. So there's a structure out there where we can get the upside of equities without the downside.
Correct. Absolutely.
And this is that universal life that you're talking about.
That's right. Indexed universal life.
Okay.
And there's many different companies, and you got to really study the companies. I mean, we have probably 47, 48 different relationships with different companies. We're constantly trying to figure out which is the best. We identify that. And they do offer the upside. They do have an uncapped upside of some of these funds. And they're big firms that manage it.
And what are they, just hedged to the downside?
No, the way they actually, if you actually want to tear it apart, they do it through options. So what happens is the insurance company takes your money. They go buy real estate. They do private equity. They do all these things that they can make a lot of money. And they have such a huge balance sheet that they can do that on a smaller level. They own a lot of bonds as well. But what they're doing to give you that return is they're buying options which give them the upside on an index. And those options that if they don't perform, they just lose that 1%. It's part of the cost of the contract. But if it performs, it gives them the ability to then offer that return to the owners of the structures.
And that's what the billionaires are doing. Those are the structures that billionaires and smart money is in.
You know, if you actually look at a company like Walmart, you look at a company like JP Morgan, you tear apart the balance sheet, you're going to see that these companies actually own these structures on their own employees.
Yeah.
It's called company-owned life insurance or bank-owned life insurance, BOLI or COLI. And these are the ideas that they see the value of these contracts. They buy it on an employee. Once the employee is no longer employed there, theoretically they don't need it anymore as a key person policy, but they don't get rid of it.
Yeah.
They hold it. And then
That's so interesting.
Because it's a guaranteed asset for
it's
them.
a guaranteed asset.
Wow.
Matter of fact, someone told me that Walmart, they look good because they hire senior citizens to be greeters when you walk into Walmart. They may not all be altruistic. They may be thinking that it's a good return.
Interesting. It's the 1% of 85-year-olds don't make it to 100 kind of a thing.
That
yeah.
is insane.
99%. Okay, so we've talked a lot about a lot of things here. We've talked about insurance, vehicles, stuff like that. But let's start with the fact that Wall Street is screwed up, right?
It's a flawed model.
It's a flawed model. It just doesn't work for the average guy. The downside in any given year in the stock market, you said, can really hurt somebody that's coming out of retirement if it goes down 20%. They're nervous. They're anxious about it. It's not predictable.
Yeah.
401ks, nice, but you don't really believe in them.
I think they're terrible,
Yeah.
actually.
Yeah.
I mean, people are putting all their money in.
Yeah.
They're getting the nice deduction in that year, but when they pull the money out,
Yeah,
we don't know what the
taxable.
tax rate's going to be. It's
Yeah.
totally taxable, and the limit to the products that you're selecting are mostly equities and fixed income. So I think the asset itself is volatile.
It doesn't align with your age sometimes, right?
Totally. Yeah.
And then we've talked about insurance. So you got term insurance where I'm just buying a policy, short-term protection
Yeah.
over 10 years. It's not really an investment vehicle. It's more
No,
of a,
it's good to protect your family.
Yeah.
It's just great. God
and then you've
forbid.
got whole life where it's forever.
Forced savings almost. It's
a
good.
lot of money, and you're getting something out of it. But there's a better product that you mentioned. I forget what that's called. Universal.
Indexed universal. life.
Index universal.
Yeah.
And this gives you the upside of the equity markets and bond markets, and it caps the downside or gets
Zero. You have no
eliminates the-
downside. Yeah, principal protected.
Yep. And that vehicle wrapped with other assets that you can get into, you can put into a vehicle that essentially is tax-free.
Absolutely.
And the idea is that your net worth, whether it's $1 million, $10 million, $100 million, you're going to be able to borrow against that tax-sheltered asset.
Tax
without-
eliminated. Sheltered, it's eliminated. That entity is a non-taxable entity. If
So-
you can put your assets inside of this structure,
Yeah.
you should never pay capital gains taxes again,
So
ever
you got
again.
$10 million, it's sitting in there,
And
it's
you
protected against taxes.
yeah, and you can
And if I
invest in
want
any-
money out of it, you want money out of it, you just borrow against it.
any structure you can borrow. This is not
And all that's doing is reducing the net asset value of that entity, but it's tax-free.
tax-free. So your heirs would get a little less if you're borrowing from it. But
Yep.
I have clients that would spend the rest of their lives, once they stop earning money, they put all their assets inside this vehicle. All future growth is tax-free.
Mm-hmm.
And whenever they want to access it, they do a loan from the structure. They use that. It's zero tax.
And you can tuck any asset in there that you want.
You need that. There are diversification requirements, so you
Okay.
can't have more than 65% in any one asset, 75 in any two, 85 in any three, 95 in any four.
Can
So
you
need
put a
5.
business in there?
So it can't be a business you have checkbook control over. You have to have a financial advisor.
Gotcha.
You couldn't put this business in, but if you were to take a step back and own equity in the company and have a professional management team running it,
Yeah.
then you
So if
could.
you have a minority interest, you're not involved, but you invested in an LLC,
Yeah.
that investment can go in there.
I have a lot of private equity clients. I have a lot of venture capitalists. If they're running that business, if it's their fund management business,
Mm-hmm.
it doesn't work. But if they're investing in companies and they put those company investments inside, they're not running those companies day
Yeah.
to day. They're an investor. That's beautiful. And imagine you have 100x. All of that upside would be tax-free.
That's incredible.
Yeah.
Well, this is incredible strategy. There's a lot more to it. You talked about, looking at personal taxes and how CPAs can just be CPAs. They're really not always in the best interest of avoiding or eliminating tax to the best degree.
Record keepers.
Record keepers. Okay. and
Expensive record keepers.
Yeah, I think they need to think outside of the box. I would actually argue the CPA industry is in huge jeopardy. I think the future of it is really questionable. They need to add value. They're the ones that should be promoting these ideas. When I bring these ideas to my clients, they ask me to talk to their CPA, and their CPA is like a deer in headlights. They have no idea. They've never taken the time to study this. And then their natural reaction is to say, I don't know about it. No, don't do it.
Well, we're going to solve that problem.
There we go. Cool.
Because Canella Media is partnering with Mandel Family Office, and we're going to bring a direct-to-consumer product to life, and we're going to promote it and market it through social media. And right now, you have a YouTube channel.
Yep,
for
absolutely. The Mandel Family Office.
Yep.
They can look me up there. They can look me up on LinkedIn. I put a lot of content out there.
We're
as
going
well.
to get on TV, and we're going to
Let's do it.
fill the funnel with your ability to help people in these shelters that billionaires use, but you don't have to be a billionaire,
No more.
even a multimillionaire to utilize it. And you can structure your wealth to pass on to your heirs and use it while you're alive in a tax-deferred way.
Absolutely. And
Yeah.
it allows you more flexibility to be an entrepreneur and go build your businesses because you don't have to worry about giving half of the money away every year to the government. You could legally keep your gross return as your net return.
All right.
I love it.
Let's make millions.
Let's do it.
Let's keep millions.
You got it.
Thanks, Jason.
My pleasure. Appreciate you guys having me.
Thanks.
So good, so fresh.
For more content like this, subscribe to Let's Make Millions and get alerts for all future episodes.